Norwegian Cruise Line beat Q1, then cut the year, which is not exactly the victory lap music you want on a cruise deck. For posterity, it's May 4th, 2026. This is Earnings Unscripted, and we're looking at Norwegian Cruise Line Holdings, ticker NCLH, Q1 2026.
Yeah, it's a good quarter, bad map result. They run Norwegian, Oceania, and Regent, so think floating hotels, restaurants, theaters, fuel bills, private islands, and a lot of debt. Revenue grew about 10% year over year to $2.331 billion. Diluted EPS was 23 cents versus a loss last year. Operating income was $233 million, roughly a 10% operating margin.
And that margin was better than last year, right? 10% versus about 9.4. But the part the market latched onto was not nice Q1. It was, why is the rest of 2026 getting uglier?
Exactly. Adjusted EBITDA beat their own guide, $533 million versus roughly $515 expected. But then management reduced full-year guidance for net yields, adjusted EBITDA, and adjusted EPS. So investors heard we executed in the rearview mirror, but the windshield has bugs on it.
Very nautical. Also, the stock did not take this calmly. Separate from the quarter-long slide, earnings day itself was ugly. It opened below the prior close and ended around $17.20, with the latest print down about 8.5% versus the prior trading close.
Tiny legal life vest before we sail too far. This is not financial advice, just personal opinions, so please don't let two people with microphones steer your retirement account. But yes, the reaction makes sense. This was a confidence reset.
The weirdest thing to me is the deposits. Advanced ticket sales jumped more than $500 million sequentially to $3.72 billion, and yet management still says they're below the optimal booking range. That sounds contradictory.
It sounds contradictory, but it isn't necessarily. More deposits can simply reflect more capacity, seasonality, and more ships to fill. The problem is the quality of the booking curve. Net yield was down. Revenue per passenger cruise day was down, and management is basically saying, we have passengers, but not at the prices and timing we want.
So, fuller ship, weaker economics. And the CEO was not hiding behind macro fog machines.
No. John Shidzy called the Norwegian brand a turnaround. He said these were self-inflicted wounds and even told analysts, we are not comparable to our peers at the moment. That is unusually blunt CEO language, not polished, more like someone walked into the engine room and found three people labeling the same pipe differently.
And yet, the consumer-facing product is still kind of dazzling. Norwegian Luna gets christened, there's an Elton John production, the Aqua Slida coaster, Great Stirrup Cay's water park coming later this year. Like, the vacation brochure is sparkling, while headquarters is doing emergency surgery.
That's the tension. The assets may be good. Management says Oceania and Regent are just fine, though we don't get brand-level numbers because they report one segment. The problem is Norwegian, marketing alignment, revenue management, deployment, and now $125 million of annualized SG&A cuts.
Including a targeted 15% reduction in salary and benefits costs, which is not a small office cleanup project.
No, that is a cultural reset with spreadsheets. And balance sheet pressure is still there, too. Cash dipped sequentially, debt rose by about $500 million, net leverage ended at 5.3 times. So the company wants to fix demand, cut overhead, fund big capital projects, and deleverage. All at once.
Okay, so headline, Q1 beat, the year got cut. The CEO basically said, this is on us. And the market said, finally some honesty, but also no thank you. All right, let's get into the details.
The detail I'd sit with is that this is not just people don't want cruises. It is, I think, a broken demand machine at the Norwegian brand level.
Okay, define demand machine, because that sounds like something living under the engine deck.
In cruise, revenue management is not just price. It is when you sell, which itinerary, which cabin, what onboard spend you expect, and how much marketing you burn to get that booking. And Mark Kempe said the quiet part out loud. We've been spending probably 2x on a per-bed basis.
Wow. Twice per bed and still behind the booking curve is
not soothing.
Right. If you're spending double and still not in the optimal range, either the message isn't landing or the product is misallocated or you're buying demand at a price that damages yield. Maybe all three. That's why the deposits number can look comforting while the economics are deteriorating.
So the advanced ticket sales thing is not a contradiction. It's like, yeah, the pantry has food, but the meal plan is wrong.
Exactly. And cruises are brutally sensitive to timing. An early booking gives pricing confidence and lets them package excursions, premium dining, all that. Late demand or weak demand in the wrong geography means discounts, weaker per diems, less control. The guest still boards. The spreadsheet has indigestion.
And this is where the Europe issue bites, right? Because if Middle East disruption makes people nervous about certain itineraries, you're not just losing a passenger. You're losing the right passenger at the right time.
Yes, and management didn't quantify macro versus internal execution. Chudsi basically said it's hard to parse, but then he also pointed at marketing, revenue management, and deployment alignment. So he is not letting the organization hide behind geopolitics.
I liked that, honestly. Painful, but cleaner. Although self-inflicted wounds from a new CEO also means I found the old machine making several bad noises.
And it also means judge me on the repair. The SG&A savings are part of that. But here's the uncomfortable footnote. Marketing, general, and admin was up pretty sharply year over year in Q1 before the savings show up.
So we're cutting the department after it got more expensive?
More or less. And the adjusted cost metrics exclude restructuring costs and activist-related advisory fees. Those may be legitimate exclusions, fine. But if you're telling investors cost discipline, the listener should hear a little parenthetical after it. Discipline with transition costs.
And a governance subplot. 5 new independent directors effective March 31st. Activist advisory fees in the quarter. That's not a conspiracy board, but it does feel like someone opened the windows in the boardroom.
Good phrasing. Fresh air plus maybe a colder room. The other deep point is cash. The company is still in a capital-heavy phase. Q1 operating cash flow was strong, but property and equipment additions were bigger, so a simple free cash flow proxy was negative by roughly $625 million.
Which is the part that makes the turnaround less romantic. You can't just say, we have great ships and a new water park. You have to fund the great ships and the water park.
Exactly. Full-year gross new build and growth capex is around $2.9 billion, with export credit financing covering a large chunk, but net of that, it is still a real call on cash. Deleveraging is the stated priority, but the asset pipeline keeps asking for lunch money.
Very polite lunch money. Billions, but polite.
The cruise industry is basically luxury hospitality with steel and debt. And to be fair, these assets are not vanity objects. Great Stirrup Cay could genuinely matter. Chidsi said this water park will be a demand driver moving into 2027. Kempa also said the earlier phase improved guest satisfaction dramatically, with the main monetizing activities still coming.
That's the human bit I keep coming back to. A family doesn't buy yield improvement. They buy, my kid will remember the giant water slide. And then Norwegian hopes that memory shows up as pricing power.
Yes. Private islands are not cute side projects. They are yield laboratories. You control the destination, the guest experience, the add-ons, the itinerary premium. If it works, it can pull demand forward and improve on-board or on-island spend.
But if the brand's revenue management system is misfiring, even a shiny island doesn't automatically fix it.
No. Asset quality and commercial execution are different muscles. Norwegian may have good hardware. The software, meaning pricing, marketing, deployment, governance, seems to be in rewrite mode.
And we don't get brand-level margins, which is frustrating. Management can say, Regent and Oceania are fine. Norwegian is the problem. But outside investors can't really see the split.
That is important. One reportable segment means we see the blended soup. Maybe luxury is healthy and Norwegian is dragging it. Maybe the gap is wider than they imply. We can't verify from the disclosure.
So let me say it back. The quarter is less about Q1 profitability and more about whether management can rebuild the demand engine before the capital plan and Europe season squeeze them.
Yes. And if I reduce it to one test, do the next few months show better booking quality without simply spending twice as much to get it? Because buying demand is easy. Buying profitable demand at scale while cutting costs and paying down debt, that is the real exam.
Okay, that tees up the bigger question nicely. If this is the repair phase, what should investors actually watch from here?
Booking quality, not bookings in the abstract, but can they fill the book earlier with less paid marketing and without crushing price?
Yeah, because the next guide is not exactly a warm blanket. Q2 net deal down about 3.6% constant currency, even with adjusted EBITDA guided around $632 million. So it says we can manage costs, but not yet demand is fixed.
Right. And the more uncomfortable part is Q3. Europe becomes a bigger part of deployment. And Campus said, quote, "There's a scenario where you could see high single-digit negative yields in Q3. That is not CFO small talk."
No, that's the CFO putting a hazard cone in the road. The optimistic read is, okay, new CEO is being brutally honest, costs are being reset, and Great Stirrup Cay gives them something tangible to sell into 2027.
I buy part of that. Chidsy's line, "We have the assets, we have the brands, and now we have the focus," is the bull case in one sentence. But focus is not cash flow. Focus doesn't refinance debt.
And leverage may still be in the high fives by year end, if I heard that right. So investors have less patience for a beautiful 2027 story if 2026 keeps asking for more forgiveness.
Exactly. My base view is not doom. It is probation. Norwegian has real assets, and maybe the private island becomes a yield engine, but the market will want proof in the booking curve, not just new org charts.
So next quarter, watch whether the Q2 yield decline is contained, whether marketing efficiency actually improves, and whether management gives cleaner color on Europe.
Yeah.
Not vibes, evidence.
And if they stop spending 2 times per bed to get mediocre demand, that would be a nice start.
Revolutionary concept. Spend less to sell better vacations.
Finance occasionally discovers common sense. It is always moving.
All right, that is Norwegian, a repair story with some very expensive scenery. Thanks for hanging out with us.
See you next time.
If you want these earnings chats to just sort of appear when the next company reports, following the show is the easiest habit. And small transparency note, Earnings Unscripted is made with AI assistance. One concrete proof point is that each episode starts from the actual company filings and call transcript notes, not random headline soup. If you've got feedback or a ticker you want us to cover, send it to earningsunscripted@datamadness.ca. Thanks for listening and take care.